All right, guys. So this is the 18th day of this teaching. I think we're after today. I think we're left with on 4 days. Yeah, we should be ending on Saturday. All right, and yeah, it has been an amazing ride. All right. So today we are going to be talking about um one of the topics I think that is one of the easiest topics, and that is lower time frame entries. Right. Um, the issue with a lot of traders is that they think that this is their problem. Right. Just teach me how to enter a trade. That is all they think that trading is all about, right? I want to just debunk that rumor, right? Um, if you don't understand the other things that we have taught, lower time frame entry is not going to do you any good because lower time frame entries are just patterns, right? They are just patterns. Right? So lower time frame entry are just patterns, right? So if, and I've told you guys in the previous teachings that if you trade patterns for pattern's sake, then you're going to do yourself a lot of harm, right? Whatever entries are nothing apart from patterns, right? A particular entry pattern. For instance, when I started trading, one of my entry confirmations then was what? An engulfing candle, right? Engulfing candle is just a pattern, a big candle covering a smaller candle, right? And you can see engulfing candles almost everywhere on your charts, right? But now, if you trade engulfing candles just because you saw it, you're going to do yourself a lot of harm, right? Because you are just trading pattern for pattern's sake, right? You have to blend in other things which we have taught here, such as what? The higher time frame key level, the trend of the market, time of the day, session, liquidity, all those stuff. Those are the things that gives your lower time frame entry an edge. All right. Your lower time frame entry alone is not an edge, right? It is just a pattern. But when you combine it with other things that we have taught here in these 22 days, and for the paid students, once if you combine what I've taught you in the paid group, then it becomes an edge. So an edge is not just a lower time frame entry. An edge is an entry combined with what other things, right? So lower time frame entries are just patterns, right? So if you focus on lower time frame entries, you're going to do yourself a disservice, right? It's just a pattern, just like we have engulfing candle, just like we have head and shoulder, just as we have cup and handle pattern, just as we have trend line breakouts. Those are all just patterns. Where you have to understand the logic behind it. You have to understand why that particular pattern should hold, why it should play out, why it be um, should be considered. Right, it's very very important. Right, so we're also talking about few lower type of entry. I think I have about I think five, right, which I use. But for the sake of this teaching, I think I will talk about two. Right, I think I'll talk about two. Right, someone will be asking why is it teaching only two? I'm teaching only two because um me teaching two would help you understand it better. Because if I start to talk about other things, it will take a longer time. In my pay group, we have videos from 2021 to date. We have been teaching from 2021 to date. So there's no way I'm going to be able to compress everything I've taught them from 2021, 2022, 2023, and then compress it inside one video. It's not going to be possible. And most of those things are very lengthy. We have classes every Sunday in the paid mentorship group. We have classes on Sundays. We teach about at least 1 hour every week. Right? We have classes for 1 hour every week. Now imagine 1 hour from 2021 to date. There's no way I'm going to be able to compress that inside these 22 days, right? We cannot compress 3 years into 1 year, right? So it's not going to be very possible. So what I will do I'll just kind of talk about the easiest ones, the ones that occur very often and frequent. And then you have to do your job by studying them, right? By studying them. Now, lower time frame entry is very, very, I would say direct, right? Something that is not too difficult to look for. For instance, we have a model A, which is what the BOS without inducement, right? So we call it the sorry, this is model A now, model A, right? BOS without inducement. So these are entry model on its own, right? if market comes to your higher time frame point of interest, so it's very, very easy, just a pattern. Like I said, you have to understand other things that led up to this. So this is a higher time frame POI now. Right, so the market is coming to a POI inside there. So as price drops inside there and you're bullish, what you want to see is what price run a low and then break a high. All right, so this is model A. So this is your this. Have you seen how easy it is? It's not a rocket science, right? Just very direct and straight to the point, right? I told you guys earlier that entry model is just a pattern. It's not something that is rocket science. Just very easy to spot, right? Once you see this, that is your entry model, nothing again. So people always asking me, entry model, how do I enter? It's as if the thing is too difficult. What you should pay more attention on is how to build the bias in the first place, how to pick your POI in the first place, time and price, that is session, liquidity, all those stuff, run of liquidity, all those important stuff, right? When you understand this important thing, the entry is just for you to just enter. That is all. It's not anything. Sometimes an entry pattern can be spotted in not more than 10 seconds. Like if you already know the pattern for that, in less than 10 seconds, you are able to spot the entry, and you can place your limit or whatever you use. If you use them as a if you use instant execution, you can do that. If you use limit orders like I do, I mostly use limit orders. So I can pick the best position and then be able to calculate my stop loss. Right. So you also do that. So you also do that. Right. The most important thing that you're able to build your bias, you're able to know that okay, the market should react at this certain point. Right. So this is the high, the price comes there. That is it. So once market takes out the high, this becomes your entry. That is all. Right. So now as market has taken out the high, you now wait for the market to come back for a retest. Right. And once you retest, that is your entry. Right. That is all. That is all about the one without inducement, just like this. Right. That is all. Right. That is all. That is all how this one functions. That is basically how it plays out. Nothing much. Just break off your high and then market comes back. Now, there in this model A, there are various ways where you can play this. Right. You can play the last down candle. So now this now can become this last down candle can now become your entry, right? You can play this as your entry, right? Or in some scenarios there can be an imbalance and then you play the imbalance as your entry, right? Sometimes price can create an imbalance and then that imbalance becomes your entry. And finally too, you can also play this breaker. I told you guys about breaker blocks. Remember, I told you guys about that. So this now becomes sometimes market can choose to play this breaker as an entry. So market also want to give something like this, and then the market has moved. Right. Sometimes market can choose to play this breaker. Right. Price can choose to play this breaker, and then off it goes. And also you can also choose to use your Fibonacci tool. You can see why it is just a pattern. You have to learn the logic behind it. So you can choose to just bring up Fibonacci to extend it, and then you just play the 62% level, which is your OTE, right? You can choose to just play 60% level. That is all. And you can just bring a fib to and just put your limit at what is 60% level. That is all. So you can choose to use Fibonacci 2 for your entry, right? So you can just choose to just put your limit order. So I taught you guys about ICT OTE. This can be your entry, right? I taught you guys in this teaching, I taught you guys about ICT OTE. You can just put your limit at that OTE level and then stop loss below that, and that is all. So the purpose of having this is so that you can reduce your stop loss. That's the reason why we have lower time frame entries. So you can also reduce your stop loss. So instead of putting your stop loss all the way below the higher time frame POI, now you can now move your stop loss was below this new low, right? So you're now reducing your stop loss from being down here to being up here, right? So that is the purpose why we use lower time frame entries. It helps to reduce stop loss, right? So you can have a little stop loss. So that is why we use it. So another way you can also streamline it. Sometimes you ask yourself, okay, which POI should I use now? But there are times in which you'll be confused. Like you will see market will break now. In this place, you're seeing another block for entry, right? You're seeing another block for entry. You're asking, okay, you see another block here. You also see what an imbalance too. You're so wondering where should I put my entry now? Where should I enter this trade? And you can see an imbalance here, and then you can also see a breaker. Also, everything is just lining up. So you're asking, where should I put my entry? Should I put my entry at this breaker? Should I put it at this imbalance? Should I put it at this other block? You'll be wondering, what should I do? Right? Now, that question is built by experience. That's what I can tell you, because there's no way to know with certainty that price is going to reject from a specific level. Right? It's built with experience. The more you trade, the more you begin to know the one that you have to use. It's not like there's any specific rule. There are times in which price will bounce off the breaker and poof, off it goes, and it won't get to the imbalance. There are times in which price would drop down for the imbalance and it won't get to the other block, right? And then off. There are times in which price will go for the other block and then off it goes. So this one is not something that there is any textbook rule to it, right? If you are seeing various people, there's no specific rule to it. But one way you can streamline it, you can kind of make it easier for yourself, is to divide the range into two. Right? Just simply put your fib tool or your gambos, divide this range into two, right? To get a premium and discount. So this is an easy way to know where to sell the POI. So you can also do like this. So now, as I divide this range into two, from this low to that high, right? That means this breaker is not important because it is above the 50%, right? So automatically I've removed this breaker because it is above 50%, right? So you can just divide it into two to get 50% of the total, that is from this low to that high, from the low to the high that broke to the new high, right? You cannot simply divide it into two, right? So now doing this has automatically doing what? Removed the breaker. So the breaker is no more a point of consideration. So you now have what? An imbalance and what? The other block. So just to be safe, you cannot simply put your limit what? At the imbalance and put your stop loss down to cover the other block in case price goes down. Right? You cannot simply put your limit what? At that imbalance and then put yourself all the way down in case price goes down, right? So your stop loss should always be at the point in which even if price invalidates your first POI, right, or your first lower time point of interest, you can still be able to weather the drawdown, right? That's how I trade. So some people come and put their limits like this. There's no point putting limits and stop loss here because price can choose to go down for that other block down there, right? So that other block is not an area to joke mess with. So you put your stop loss all the way down to avoid this kind of issues. Your stop loss should always be down below this swing low, so that even if price pushes down, like a long wick, taps down, you're not going to get stopped out, right? So that's one of the ways to streamline this, right? You just simply divide the range to two and then target the POI that is below. So in cases where maybe the breaker is down, let's say the breaker is very down, like it's at 50%, like it's all the way down here. It's around 50%, right? It's all the way down here. So in this case where you can see that the breaker is at 50%, you can now put your limit there to see avoid problems as well. You can still put your limit at that breaker now because now it's at 50%, and then you put your stop loss all the way down to avoid problems, right? So that is how to do it. So sometimes you have to use a large stop loss to avoid being stopped at. And remember, at least a lower time frame. So lower time frame simply means that the pips will not be too much. Highest 30 pips, 25 pips, 5 pips. So it depends on the market condition, right? There's no amount of pips that is standard, right? Sometimes a trade can give you 15 pips, sometimes give you 14 pips. So it doesn't really matter. All you do is that you simply do what to manage your risk. You use your forex calculator to calculate your risk. That is the most important thing. Just make sure that you're calculating your risk. You know that stop loss for 15 pips will not be the same with 20 pips. Stop loss for 30 pips won't be the same with 10 pips. So you have to use your lot size calculator to calculate what lot size to use to avoid, making mistakes. So it doesn't matter that is 5 pips, 2 pips, 3 pips. It doesn't matter. Just know that you have your calculator with you to calculate your lot size. Use your forex calculator. There are many apps. Like I use an app called Forex Calculator. It helps to calculate lot size for me, so I can know this. I should use this lot size depending on the number of pips and the risk I want to use, right? So that is basically how this is done. So there's no specific. Maybe I was asking my students, so my pay student, I was asking me, how do I know which one to play? I've extended it now. Divide the range into two and take the ones that are below 50% or at 50%. So either at or below, right? It can be just at 50% or below it. So that is how you're able to pick the one to use. And your stop loss was, if you have like 3 PUI now, your stop loss should go below the swing goal. But if maybe there's no other block here, right? Maybe it's only the imbalance that's here. You can maybe put your stop loss maybe below the last candle of the imbalance, right? So if maybe there's no other block down here and it's just this imbalance, you can still, to make your stop loss smaller, right? You can just put your entry at the imbalance there and maybe below the imbalance, right? To have a better stop loss. So imbalance without a POI below. You can just play the imbalance alone, and then you don't have to put yourself all the way down here. You can just put it somewhere below the imbalance, and then you're good. Right. So it just depends on what the market condition is given. Right. There's no straight way to trade. Right. Trading is not static. It's dynamic. It's always changing, always evolving. So you have to be flexible enough to also follow the change. Right. So you have to be willing to make changes, right, depending on what the market is giving you. Now, I want to also point out something too. Now, another kind of model A. So an alternative version of model A. This is model A with PY. So another alternative version of this is when price runs liquidity. So it's not only when price hits PY. So you can have maybe a liquidity, maybe a low or high, yeah. Right, high liquidity, and then price runs it. So this is also an entry model too. So price runs a liquidity pool. So that gives you that break of structure. So this can also be an entry too. Right? So this is also an entry model. So the price runs liquidity, as it runs maybe an equal high, or it runs a POI, or a point of interest you're looking at. So the market is bullish, and then that runs a low from the previous day. Now this can also be served as an entry too. This same entry pattern. So when market breaks a high, then you can look for your entry. Remember there's a liquidity pool resting here. Remember liquidity. That is equal high, equal low, double top, double bottom, triple bottom, Asian high, all those liquidity kinds, right? Previous daily high, previous session high, whatever it is, right? Liquidity is resting here, right? Liquidity is resting at that point there, right? This liquidity is resting here, and price runs that liquidity very well. So this can also serve as an entry as well, right? Another entry. So when market hits it, that's your entry, right? That's your entry model, right? Because what liquidity has been run, that's been taken out. So now this same thing, you can also do the same thing. It can be an imbalance. Yes, you can also bring a fib to mark out the middle of the range. Just take it out. That's all. Bam. And then you mark your 50% and then take your trade, and whatever the case may be. I told you that it's not dynamic. Sorry, trading is not static, right? It's not static. Trading is always moving. Now, model B, which is the last one I'm teaching you guys, actually 5 I use. I'll teach you guys only 2. So model B is the BUS with inducement, right? So this one has some kind of trick to it. So the only difference here is that price, does something like this, hits your POI, right? Market hits a POI and then create some kind of inducement before coming towards the original entry. Right? This is also a very nice one. So markets can also choose to do. So this is a POI now. Now price can hit your POI, make your break of structure, and then create that inducement, right? So this sounds an inducement. This one is usually more high probability because of this inducement, right? This is usually this entry is usually more high probability. That means I feel that this one has a higher win rate than this, right? Model A works, model B works, but model B tends to have more or a higher win rate or higher risk reward than model A because of the presence of an inducement, right? This one, model B, tends to have a higher win rate, right? So I have to teach you guys both of them because model A also works too. There are times in which price would not give an inducement. So it's up to you. You can choose to say, okay, me, I only trade model B, right? I'm here to teach you, and then you want to pick your choice. I'm not the one to tell you trade like this, trade like that, right? I've taught you several things. It's up to you to select what you think is best for you, right? I have about I have trained about 200 and something students, and I can tell you for free that out of those 200 students, they don't all trade the same way. Like they have their own unique approach. Right? There are people that have their own unique approach. That is why you have to study. When you study, you're able to build your own specific edge. And I was seeing a question that someone asked me, what is my edge? There is no way I can teach you my edge. You have to build your own edge. Right? You have to go through it and then find out what works for you. Right? The way I trade is not exactly the same way my students trade. There are my students that can trade on 1 hour, hold on the 1 hour chart and then hold for 3 days. I can't trade that way. There are those that can take trades with 1 minute and they're done in a few seconds. Like sorry, I can take trade in 1 minute and they're done in like 10 minutes. They're done. I have students that they like lower time frame so much. They can use 1 minute and then capture like 1:10 and they're done. So that I have ones that like to trade maybe 15 minutes charts. There are the students that like to trade gold. There are some that like to trade on currency pairs, so like synthetic indices. So that's why I say that there's no specific edge, right? You have to build your edge. The best edge is what you build yourself, right? And how do you build yourself? By rolling off, like by rolling your sleeves and doing the work, right? You go to the market and study which one do you understand best? What can you really understand from this thing that has been taught? Right? That is how you build your edge. Edge is not taught, edge is built, right? You don't just come and copy someone's edge, right? You just come and just come to want to copy the way I trade. Right? It's not going to make sense to you because you don't know everything I know, right? You don't know everything I know, right? And the things I know have been built with experience, right? This is one of the issues that a lot of students struggle. A lot of students struggle with this. They are trying to copy their mentor's experience. It's not possible. How can you copy my experience? Do you know the things I've seen? How did you study with me? Right? You didn't study with me. You did not experience the things I've experienced. You didn't take the same traits with me. You didn't have the same financial condition with me. So there's no way you can just copy my edge because my own edge is based on knowledge and experience. You can get the knowledge, but you can't get the experience. So without the experience, the edge is still what? Without completeness or without wholeness, right? Do you understand that? So there are things you have to experience. Like for instance, now in my paid group yesterday, we are looking at the Nasdaq trade, and I told them that this trade is not going to hold, right? One of them was like, "Let me buy, let me buy, let me buy." I told him, "No, this is not going to hold." And the reason why I could tell her this is not going to hold is because I have had the experience. Meanwhile, someone else without experience will think that that is an edge. You understand that? It was a setup that we use. Remember what I said earlier, that entries are patterns. So yesterday, there was a pattern that showed up, and it is usually what? A pattern which I even use for my entries. But at this exact time, due to experience, I knew that this was not what good for taking, right? It was a pattern, but the higher time frame bias was not in support. So I told my paid students in our paid group, right? Like I told my the guys, this market will not play out. And it did not play out, just like I told them. Because of why? Experience. So you can just come with your knowledge now and say, okay, me, I know this pattern, I know it, I've seen it before, and then you go and take a loss. Meanwhile, me, I'm coming with not only knowledge, I'm also coming with my experience. So my experience like gives me an edge over you that have only knowledge. So that is why I encourage you guys to study and build experience for yourself because you cannot transfer experience to somebody. It's not possible to transfer 4 years or 5 years or 10 years of trading to someone else. It's not possible. The person has to roll his sleeve and study. This is what makes the difference between those that make that standard and those that struggle because some just want to copy. They don't want to do anything. They just want a fast food approach. Just give me a fast approach. Just tell me everything. Just tell me. I don't want to study. Just tell me how to enter. How do I do my analysis? Just tell me everything. Right? Just tell me which trade to enter. Just give me the signal. Just tell me. I don't want to study. I don't want to. That's how many of you are. I don't want to know. I don't want to copy. I don't want to study myself. I don't want to backtest. Just tell me this is how to enter the trade. This is what to look at. That is all. I don't want to do any work. It doesn't work that way, folk. If you want to do that way, you might just go and look for a job, right? Where maybe in a banking job, can tell you how to just do it just like that. No work. Just when the money comes, you do this way. You open the machine this way. That is all. So in trading, you have to be the experience, right? So experience is built with study and paying attention to important details. So this built with engagement tends to play out based on my experience. This one tends to have a higher win rate than this, right? If you study this very well, it tends to have a higher win rate than this. But this model A occurs more frequently than model B, right? So it's up to you to know which one works. So this is just simple market will create an inducement, and then you will see those. Normally you see big beginning balances here. So this is how you should know. You usually know this one. Normally, you likely see imbalances in this one, right? It's most likely you see imbalances below. Very most likely, you usually see an imbalance below, and then you usually see an order block which was not tapped into. You just kind of see one big order block here that price has not tapped into. So that's how you kind of know this one's going to play out. You see an OB which price just ran away from. Normally I told you guys in one of the teachings that mitigation is price coming back to a zone. So when price also runs away, that just break it runs away without coming back. That's left an area that needs to be mitigated. So that area, that's other block or zone that was not tapped into. Market just ran away. It needs to come back and tap there. So that is how you know that an inducement will hold because that area that you expected price to tap from, price did not come there. It just ran away, right? So that becomes an area of interest for the future. Right? That's what we call an abuse with inducement, right? So that is basically it. It's just that there's usually an inducement high before the PY. And sometimes it might look like this too. Sometimes it's not just one low that forms. Sometimes it can form like three lows, right? sometimes it can look like this, right? Sometimes this can look like this. You see the market do something like this. Can look like this. Creates the first one, then creates another one, and then finally comes back down to tap in and then go higher. So sometimes the inducement is not just one, it can be 2 or 3 legs, right? But it's not finally come back to the original PO and then what's run away. So this what you're paying attention was this very last inducement before the original POI. So it's a very, very good one. So very nice amount of interest. So let's just look at a few examples. I think there's two I can teach for you. I can teach you guys, right? The other ones are the ones that I teach my paid students because I've actually taught them a lot of things for a long time. So they're the ones that can relate to those things, right? So I cannot teach those ones here because those ones will take me a lot of time to explain, right? To take me time to explain. I can't explain what I've been teaching for the past 3 years in one, in 1 month teaching. So if you want other entry models and better explanation, you can always use the link in the description to join our pay group, right? It's not too expensive. Just join us, and then if you want more of that, right? It's not compulsory, right? These two a lot enough. I think I took a trade on good yesterday, and I also used that example to explain it. Right? Although I did not post it, I only posted it in my paid group. Right? But these days I focus more on my paid students. Right? I'm not really focused on the general community when it comes to posting and explaining trades. Right? I don't owe them that. All right, so let's use, I think it was on 15 minutes yesterday. It was on good. Yeah, I remember the trade I took yesterday on good. It was a buy. All right, let us quickly talk about that good trade. Let's go to the 5 minute chart. I think it was this. All right, so this was a good trade. Yeah, I see it. So this was a good trade. Let me put in my Asian indicator too, so I can see what I'm looking at. My God, this is not correct. Let me see. Let me see. It's not correct. No, so let me just take it out. Let me just see. Okay, so I think the good trade was somewhere around there. All right, so this was a good trade. Yeah. So this was a good trade. So it was somewhere around there. It was a London session. All right, so I think it was in the London session. All right. So let me just quickly check the trade. I've forgotten the trade exactly. Let me just check it quick. All right, so this is the trade. I have seen it. So sorry, I had to check it. I had to pause the video to check the trade because I forgot where I took it. So it was from here. Yeah, I see it now. So this was the trade. You can see that price ran an inducement. So I was looking at this as an inducement. You see it's very clear in 5 minutes now. If I go to 5 minutes, so this was my inducement, right? Those are inducement I was looking at. So I saw price come to my POI. Here's the POI. If you check on the higher time frame, I think 1 hour or thereabout, you see that we are coming from an area of interest, right? So I think we tapped into this other block here. So that was my point of interest, I think. So I think it was the reason why I was trying to buy. I think we tapped into the high of this other block here. We tapped into the high of this other block. This was the high of the other block here. So I was like, okay, this is a point of interest, right? So that's what I was looking at, the high of the other block there. So that's basically why I was looking to take a trade from that point. So as price came there, we took out Asian lows and all of this fun stuff, right? Which I might not be explaining in details because it takes me a lot of time. All right, so we took that out, and then inside here, right, I saw a bullish break of structure. So market took out my swing high. This was my lower time confirmation, and then I saw an inducement, right? So this was an inducement entry just right there. So bracket created that inducement right before my original PY. So what was my PY? You see it on the 5 minute charts. So price came to the 5 minutes PY. So you can see 5 minutes PY, right? So you can see in the 5 minutes 5 minutes PY, or was it on the 3 minutes? Right. So price broke structure, and then I think I was looking inside this particular area, right? Inside this particular area, there was something I was looking at inside. I think I was let me check it 3 minutes and be sure. Because there was something I was looking at on the lower time frame, which was my area of interest. Why I was very interested in this. Okay. All right. So I think I was looking at something here, and I was like, okay, there's some imbalance inside here. So this is what I was kind of looking at. This imbalance, an imbalance inside these points here, which price left. Right? Price is not happening to this imbalance there. Right? And I could see all this inducement here. So this was the last imbalance, right? This was the very last imbalance before, this was the last imbalance before the markets pushed above. So, and this imbalance has not been filled, it has not been tapped into, right? So that was what I was looking at, and then I just simply played that, right? So my major focus was that inducements, right? As price took out the inducements, I just took my trade. So my main focus was price taking out this inducement, and then we had this big red candle. So I just simply took my buy below this inducement, right? I might not be able to show the screenshot because it's actually my journal, right? The screenshot is my journal, right? It's in my journal. I can't, open my journal right now. So my pay students actually saw the trade when I posted it. So we took out the inducement there, and then I bought towards this particular high here. Right, so those were what I was targeting. I also got take profits. So we bought down here, and we targeted what this high here. Right, so targeted the last high. This was the high we were targeting as overall TP. Right, it was very easy. So price took out the inducements, right? We bought into what this high there, right? So this is a typical inducement kind of entry, right? Very, very simple, right? So very, very easy. That is one I could remember from yesterday, right? Very, very easy trading system, right? And it was on gold, right? So that's basically what I'm going to be, that's only the one I'm going to be explaining. So I want you guys to backtest on your own because this video is already very long. So backtest on your own to spot these things for yourself, right? Spot the entry with inducement and the one without inducement, right? So you have to, I told you, entry is just a pattern. Have you seen how I had to, start explaining Asian high, Asian low, there are things that are behind it that makes it an edge. These are the things that you cannot just learn in 30 minutes. The things you have to, use time to learn, right? You need time to learn all those things, right? Sometimes I cannot teach you in 30 minutes. It's not possible. Because now I've mentioned Asian high and low. How am I going to start explaining that from scratch? I'm going to explain the timing, a lot of things that goes behind the scene. So seeing entries are not very important if you don't understand the bias behind it, right? So this is why we're ending this call for today. Have a wonderful day. See you tomorrow, session tomorrow, talking about how to develop, the mindset for trading, right? Maybe a few come with wrong mindset. So we're going to talk more about how to develop the habits, habits that help you to excel as a trader. The things you can put in place to, see that constant level of results, right? So have a wonderful day. Do what to backtest the study and show yourself approved. Cheers and God bless.